Got a possible ratings update from ratings agency Moody's. Moody's Investor Service has placed on review for downgrade the long-term deposit ratings as well as long-term issuer and senior unsecured debt ratings where applicable of 9 Nigerian banks. And just to repeat, there are 2 specific metrics that Moody's is looking at: deposit ratings and the long-term senior unsecured debt ratings of these banks. We're going to bring in Joshua Odebisi, who is a Sub-Saharan Banking Analyst with Vetiva Capital Management Ltd. Joshua, good morning to you. Thanks for joining us. So those metrics, can you break those? What do those mean?
Right. So just the first one is long-term deposits is basically like think of your time deposits in a bank, so your fixed deposits. Yeah. Right. And so those are more expensive deposits than your basic current or savings accounts. So those are a bit more expensive in terms of funding for the banks. And then for the second one, those are unsecured debts. Those are just debts that are not backed by any collateral. And, most of them are Euro bonds and the like that the banks have gone to the international market to take on debt to fund their business, basically. Great stuff. All right, so let's look at the 9 banks in question that Moody's is reviewing. So we've got Access, we've got Zenith, we've got First Bank, UBA, FCMB, Guarantee Trust Bank Limited, Union Bank of Nigeria PLC, Fidelity, and Sterling Bank. This quotes from Moody's. I want to ask you whether this is, I don't know if they're being alarmist or if it's overblown. It said, Moody's decision to place the long-term ratings of these 9 banks we just looked at reflects the risk of increasing foreign currency rationing that could compromise the bank's operational ability to meet their foreign currency obligations, as well as the risk arising from a potential material depreciation in the exchange rates. Maybe you can break that down and tell us what do you make of their assessment, I guess? Well, I mean, to a large extent, it seems only fair that they would ask the question of, because of the fact that we're having a few FX liquidity challenges, whether these banks will be able to meet their foreign currency obligations in the long term. Now, let's also remember that these are all long-term related issues, not in the near term. They're not saying that within the next 12 months, the banks will not be able to pay back their loans or be able to, meet their obligations. But they're saying that the long-term issues that we've been having for quite a while, but we've been able to manage, could come towards us in terms of being a little bit of more of an issue in the next 12 months. That's really what they're saying. It's not really being an alarmist, but they are sounding some sort of alarm in terms of telling foreign investors that we do not think that these banks, or rather we think that these banks are under a little bit of an increased risk of FX liquidity shortages as time goes on. Okay, there's another quote from them where they said, let's take a look at this second part here, where they said the review for downgrade on the long-term ratings also captures the risk that a potential material depreciation in the country's foreign exchange rate could pose to the bank. So I guess that's the value of the naira against the dollar, and what that would mean. So it could impact capitalization and their asset quality. Yeah. Okay. So basically, this now relates to the bank's foreign currency loans. Okay. Right now, if there is a material devaluation, that's a serious devaluation of the currency, that would obviously mean that the bank's loan books or their foreign currency loans would increase materially, and it would also put at risk the obligors' ability to pay back those loans. Obviously, because if the exchange rate is higher, that means that those the people who took out those loans, those debtors, would have more to pay back. And that would increase their risk. And so that would probably reflect with regards to an increase in NPLs, which would affect capital. Okay. They also gave, they said, I think the loan book, if we take a look at that, I think it's 40% of the loan book of the banks in their pool that they're reviewing have FX exposure. So is that, if you compare that, I guess, to other other African countries, is that high? Or, because 40% is almost half of your portfolio, right? So if you got almost 40% exposure to FX, is that a worry? Well, I think relative to other banks in other countries in Sub-Saharan Africa, I wouldn't say that it's too high. I would say that 40% of your entire loan book, I mean, obviously, as the years have gone by, a lot of, especially the larger banks, have sort of rearranged their loan books and reduced that proportion significantly, because I think it was a bit higher before. And so you can imagine that, obviously, because of the increased risk of FX liquidity challenges, they have been more proactive in reducing that and converting some of those foreign currency loans into local currency loans in order to ensure that, you know, the risk of default is reduced. Now, you could think about it this way. A country like Zimbabwe that has had FX liquidity challenges, the banks there will not have high foreign currency loans. Yeah. Just because of, you know, the nature of the economy in terms of giving out loans to anybody. But at the same time, international companies will still probably be their main customers for foreign currency loans. And I think that is actually the case for those Nigerian banks. Okay, great stuff. Now, listen, if you know what, around the same time this report came out, Fidelity Bank made an announcement that they were making a payment of, I think, $412 million or so on their on a bond issued about 5 years ago. So I guess within the context, this wasn't really news, right? Within the context of what we're talking about here, I guess the value of the Naira today versus 5 years ago and that 400 million payment, is that part of, within the context of what we're talking about? Does that fit in? Are they paying more because the currency is not as strong as it was 5 years ago? How do you put that within what we're looking at? Yeah, within the context of what we're looking at, obviously that 400 million, when they borrowed it, they probably borrowed it at, you know, almost half of what the black market rate is today. But in terms of the official rate, the depreciation is not quite as severe. At the same time, obviously, it is a much bigger obligation. However, I would say that most of those banks have those things in mind because they know that they have foreign currency debt obligations, so they have to manage their liquidity in order to meet those obligations. And I don't think that there's any major issue of them running risk of missing out on coupon payments or even full repayments. Right. And if they think that there's going to be more of a risk in the long term, then they can do what someone like Zenith Bank did, which is pay back earlier, or call in their debts a lot earlier in order to ensure that they pay it off before that devaluation occurs. Gotcha. What other headwinds outside of FX are banks looking at, I guess, you know, in your view? Well, okay, so the thing is, right now, as with this Moody's report, the truth is that this will make investors and, you know, possible lenders more scared or skittish to borrow to Nigerian banks, and so that is going to raise the cost of borrowing. And already we've seen that MPR has gone up. Minimum savings rate has gone up because it is 30% of MPR. Right. So the cost of funding for banks is going to continue to rise. I think it came a bit later in the second half of the year, so probably we'll see that reflected in Q3 performance and also Q4 performance, but definitely throughout next year. So I think a lot of banks might have front-loaded with their H1 results, and so we might not see that same level of growth just because of the fact that even though they are probably getting more in terms of interest income, they're also paying out a lot more in terms of interest expenses. So the expenses are going to go up and continue to rise just due to the fact that there's such high inflation, and the CBN and the MPC are trying to manage that with higher policy rates, and that is going to definitely affect cost of funds, and that is really the biggest headwind right now to banks' profitability, I think. In fact, I think we're getting inflation for Nigeria later this afternoon for September. I guess the is now a good time to be expanding across the continent as far as the Pan-African strategy is for some of our banks within the context of what we're talking about. Absolutely. Yeah. Well, the thing about it is the more diverse your portfolio, the less exposure to risk you have. So when you're in multiple countries, a lot of these countries will not have these same foreign currency liquidity issues that we're having. So any revenue you are able to get from there, any foreign currency you're able to derive from those markets will obviously help you in terms of dealing with your obligations, even if your major market is going through a little bit of a challenge at the moment. So of course it's a very big bonus for your access or any of your other banks that are really, really big in the continent, because any market they enter, there's going to be more opportunities to get FX and probably balance their books that way. Gotcha. Outlook for Q4 and I guess early next year, or how you see 2023. How do you think things look? Yeah, like I said, so for Q4, definitely cost of funds is going to be higher. So interest expense is going to definitely affect the bank's net interest margins. In terms of non-interest revenue, it all depends on economic activity to a large extent, but I think that the banks are pretty solid on that. We've seen continuous growth on that front. But if the economy or the liquidity, FX liquidity issues continue to rise, and we do see any kind of material devaluation, that could affect non-performing loans, that could affect impairments, which would affect profitability. But I don't think that that's very likely, at least not in Q4.
Joshua Odebisi, Sub-Saharan African Banking Analyst for Vetiva Capital Management. We appreciate your time. Thank you so much for joining us, Joshua.